Welcome in. Thanks for watching the Everything Money channel. As always, we're here with Paul, Seth, and Mo. This is incredibly highly requested, a very popular company, a Chinese company. Paul, you've given your thoughts and opinions on evaluating Chinese companies. There's not a lot of trust on your end. A lot of
people's ends, not just mine.
Of course, no, it's not just you. Alibaba was recently fined $2.8 billion by the Chinese government. They said that there was this penalty was basically they'd abused position. They abused its dominant position over rivals and other merchants selling on its platform. Unfortunately, this fine, as I described before, a fan of ours, Tom Nash, who subscribes, did a couple videos about this what sounds like a very hefty fine, but in comparison to how much revenue they supposedly make a year, it's not too much. So you have overall thoughts on a Chinese company, Paul, like Alibaba. What do you?
There's been a lot of concern in the past with a lot of people, not just myself, that the data coming out of China can be manipulated a little bit. I don't think it's even a speculation. It's happened a lot in the past. Luckin Coffee was a very big indication. Doesn't mean that all Chinese companies are fraudulent, but I remember even with Alibaba a few years back when they had their big Alibaba day, it was kind of like their Prime Day. Somebody wrote an article about, wait a second, how is it possible they did this much in revenue in one day? I mean, it was a very controversial number. I personally believe there are plenty of companies in the US to buy. However, Alibaba is very big. We used to buy off Alibaba. We used to get a lot of contacts through Alibaba. We've now since gone away from that, but Alibaba is a great resource for people all across the world. So I do not deny that, but I do say be very cautious going forward with all Chinese stocks. I don't know how the auditing works for them, but I believe there's questions about the auditing and who does it. I don't know. Bottom line is, let's look at the company, but I do give that kind of like disclaimer ahead of time.
The point of all this is Alibaba got slapped with this fine, and their stock.
What was the fine? 2.8 billion?
Yeah, 2.8 billion. Their stock went up because of this, and so in this.
Wait, what?
Yes, that's why we're bringing it up, Paul. People are shocked as the stock went upwards of 9%, maybe finished somewhere between yesterday up 6-7%. And so what we want to do in this video is analyze Alibaba, the fundamentals of the company, to see is their stock price justified by the amount of money they're making or so-called making. Go ahead, Paul. What is the market cap for Alibaba?
$655 billion, big company. 28 PE X, very healthy profit margin, 36%. Now this is interesting, guys. I don't get how the gross margin and the profit margin are this close to each other. Because what do they pay in taxes? If you look at this, guys, let's say a company had $100 in revenue and they had a gross margin of 45%. That means they make profit of $45. Let's assume they have no other costs, which clearly isn't reasonable, and they pay a 30% tax. They're down to $32, which is 32% of $100. Are they not paying tax? How is their gross margin and profit margin so close to each other? It could be the timing of everything. I don't know, but that's kind of interesting. I never really paid attention to that. But of course, my cynicism's up based on manipulation, etc. So 1 check, 1 X.
Pillar number 3 of our 8-pillar analysis is revenue growth over the past 5 years. We want to see the company growing.
Big time. 16 billion to 73 billion. Check mark there.
And how about pillar number 4 is the profit growth, Paul, of Alibaba?
It's doubled. It's not even doubled. But it's a check mark. So the revenue is up 5 times and the profit, or 4 times, the profit's up less than double. That's weird. Why is that?
1 X and 3 straight checks. Pillar number 5 is shares outstanding. We want the shares going down, Paul.
Well, they're going up. 2.45 to 2.63.
Oh boy.
Sad.
Pillar number 6 is current assets over current liabilities, Paul.
$91.5 billion in current assets, 55 billion in current liabilities, so definite check mark there. And according to their numbers, they have more cash on hand than total liabilities. So they can pay off all their debts easily with their cash on hand. That's a big check. That's like my favorite check mark of all check marks.
Pillar number 7 is free cash flow growth. This is cash from operations.
Now, since we're using Y charts,
minus capital expenditures, Paul.
We have to do this manually.
How dare you interrupt me? Go on.
7.2 to 19.4. Check mark there. Numbers in the middle, 11.6, 14.5, and 15.1. So for the average of
67. I got it.
divided by 5.
7.8 divided by.
With an average of the last 5 years of 13.56. Now keep in mind, it's been going up. This is why we have that multiplied by 20.
13.
And we have a market cap of around $270 billion.
So you came up with a desired market cap of 270 billion.
Based on a 20 times PE. And the market cap 650. So I think it has to fall easily in half. However, guys.
The actual, before you get there, Paul, the actual market cap was 655 billion.
Now remember,
a drastic difference.
If the numbers are accurate here, this is a very, very fast growing company. This is one of those situations where you might want to consider paying more. I love the revenue growth. I don't like the profit growth. I don't like the fact that revenue has gone up 4 or 5 times and free cash flow is only going up 2.5 times, 2.6 times. I'm wondering why that is, especially with such a high gross margin. Yeah, this isn't adding up to me. I'm sorry. Like, they have a high gross margin. When your gross margin is so high and you really drive revenue up, what should happen to profit? Unless you're all of a sudden, I mean, they could be investing a lot with people and all that stuff to really drive more growth in the future, but man, it doesn't really add up very well. But the bottom line is, I'm not buying it at this price. I would probably be comfortable buying. I'm willing to pay more than 20 times free cash flow if I believe everything I see. Maybe I want to drop in half. Maybe in half, right? Because it's already selling for what, 40 times? What was the PE? 28.
Okay, I was going to say 23.
Yeah,
so it's the price is currently 241. It was almost 300 last fall. Yeah, 307 last fall.
The last time is where I wanted it was April of 2017. You're probably thinking to yourself, what a crazy guy. Look at that. It's like, well, first off, it's down 25% since the fall.
Mm-hmm.
Secondly, we're in the biggest bull market in history, so it's not uncommon for us to see stocks haven't gone to where we want to buy them for a very long time. Fast forward, there's going to be a time in the future where every single stock, not literally every single one, but a lot of stocks are in the money. And people are going to be like, Paul, every stock you do is selling for less than it's worth. How can that be? The same way it can be that every stock we look at is selling for much more than it's worth. That's when you sit there and figure out which ones are selling for the biggest discount to intrinsic value. This one needs to fall easily in half for me to be interested, and it's not there right now. But it will at some point sell at a price. I'm not saying it'll fall in half, but at some point it'll sell at a price that makes sense.
I was remiss in not introducing Trader Mo. Trader Mo, our momentum trading specialist. Mo, what are you hearing about Alibaba, and what are people in the bid-and-ask nation doing with this stock?
So they are loving it right now. This is with that big 7% jump. It's on everybody's mind. Everybody's looking at it. It's in a lot of watch lists right now. So I think if this trend continues to go higher, this is going to be something that people are going to be buying from a chart perspective in the next few weeks. So this could be something that could give us a little bit of a run and make people some money.
Paul, I want you to be very clear in that you need this to fall in half because of your mindset behind investing.
So my idea behind investing
because the comments below are going to say that you're totally wrong. This is a insanely growing company. Yes. Regardless of fudge numbers out of China, you're missing out, Paul. Of course you are. And
I was going to show my favorite example. Company A, Company B. Company A makes $1 a year for the next 4 years. 1, 2, 3, 4. Company B, $1, $2, $4, $8. Doubles every year. Okay? Which one should you pay more money for?
The one that's growing?
Yeah, you should pay more. Okay, great. Now, let's say this is going to go on forever. It's going to double every year forever. This one's going to stay at $1, right? Not double every year forever, but it goes up. You get the idea here.
Mm-hmm.
Would you pay $1 for this company, for Company A?
Absolutely, yes.
Would you pay $10 million for this company?
No. Well,
now, obviously, it doubles forever, then yes, you would probably. I don't know. Because it's doubling forever, yeah, you would. But let's just say it goes up by $4 a year the rest of the time.
Okay.
It's growing, this one's stagnant.
That's way too much. That's way too much, Paul.
Yeah, way too much. Okay? Would you pay $10 million for this company, making $1 a year for the rest of the time?
Of course not. That's silly.
Would you pay $1 for this company?
Absolutely.
Okay. The whole point I'm trying to make here, guys, is every investment, it's a present value of all future cash flows. You have to look at what the future cash flows will bring and bring it back to today. I want you to always remember this example to know that you can overpay for a growing company and underpay for a stagnant, boring company. Eventually, the markets, over long periods of time, will eventually see the value in boring companies that are selling at good values, okay? You have to always keep this in consideration that it's not about what the company is doing, it's what you're paying for that doing. You're paying for that growth. Growth is a very, very, very important factor in value investing. Probably one of the most important factors. But everybody will sit there and say, you don't factor growth in. I absolutely factor growth in. I just sit there and say, I'm not going to pay whatever it takes for growth, which is what most people do. Because they don't understand the numbers and they say, oh, it's growing, I will pay whatever it takes for that. And that's where mistakes are made. I believe in growth, but I believe in paying a reasonable amount of money for growth. I'm okay if this company is going from $4 in profit to 3 to 2 to 1 to 0. This is dying. It's still worth something. If I were to tell you I'm going to give you a cash flow of 4, 3, 2, 1, that's $10 the next 4 years, what would you pay for it? $5? Of course you would. You can get $10 back in the next 4 years. You're going to make 20% of your money. Would you pay $20? No, of course not. That doesn't make any sense. That makes just as much sense to me as paying whatever it takes for this stream. And you're going to sit there and say, well, no, Paul, it's not the same thing. It's the exact same thing. You are doing the exact same thing with your Teslas and you're overpaying and all this thing. The great news about our software is that it can give you that number based on your assumptions of growth. It'll tell you what that present value of the future cash flows will be. Don't be like everybody else. Don't be the lemming that has the cliff, whatever a lemming looks like. Oh, that's not sharp enough cliff. That's more like a hill.
Yes.
Let's go like that. This is what everybody who overpays for growth is doing. Eventually, the growth stops, guys. And when you overpay for growth, you're overpaying, and once it does hit those growth projections, you've now paid already what it should be, so you've made no money. That's a hard thing for people to understand, but it's absolutely true. The present value of all future cash flows. That's what you got to ask yourself. What's it worth to me?
Alibaba might be a great company, but currently it's not a great buy unless you're trading it. And if you're into that, you can join the BitNass Nation in our Patreon. The link is in the description below. We offer 3 different tiers. And this week is our week that you patrons out there get the wonderful software. You've been waiting a long time. It's finally coming out. And we're very proud to have a Patreon that's bringing so much to our members, Paul, with the software, with the interaction, the live streams, the exclusive videos. We're doing all of that in Everything Money Patreon. So check that out. It's growing beyond our wildest dreams, and we thank you for that. That is our take on Alibaba. Make sure, as always, you tickle Paul's belly on the way out. Fondle that thumbs up, and we'll see you in the next video. Thanks, guys. Appreciate it.